From the collapse of the Bretton Woods system to the rise of the petrodollar, the dollar's hegemony has leveraged monetary policy cycles to establish its global reach. Yet, amid mounting debt and heightened financial vulnerabilities, its dominance is showing signs of decline. Today, as the wave of de-dollarization surges and the trend toward a multipolar global economy emerges, the dollar-dominated international economic order faces profound transformation. As the sunlight of 2025 illuminates the bronze bull statue on Wall Street, pedestrians hurry past this landmark symbolizing American financial supremacy, their hurried steps betraying underlying anxiety. The turbulence in the global trade system, the rise of emerging currencies, and the persistent pressure of domestic debt in the United States continually pose a core question. Has the half-century-long myth of dollar supremacy reached a historical crossroads? This economic restructuring, born under the shadow of the Vietnam War, traces a complex trajectory from the collapse of the Bretton Woods system to the rise of petrodollars, from the global harvest of prosperity to the erosion of hegemonic foundations. Behind this intricate narrative lies the underlying logic of shifting global economic power. In Washington, D.C., in 1968, the lights in the Oval Office burned through the night. Newly inaugurated President Nixon's fingers traced the Vietnam War expenditure reports, his brow furrowed like a twisted knot. That year, war costs consumed 4.2% of U.S. GDP, an ever-expanding iceberg suffocating the American economy. Across the ocean, factories in Germany and Japan hummed with activity. Cars and electronics flooded global markets like a tidal wave, quietly eroding American industrial supremacy. More critically, the 24-year-old Bretton Woods system teetered on the brink. Like a house with rotting foundations, it threatened to collapse at any moment in the storm of the dollar crisis. The dollar at that time resembled a giant harness to a golden chariot. Under the Bretton Woods rules, national currencies were pegged to the dollar, which in turn promised a fixed exchange rate of $35 per ounce of gold. Yet the poisonous tumor of the Trifon dilemma had long been planted. The dollar had to flow globally to meet trade demands while simultaneously maintaining its value to guarantee gold convertibility. This was like asking a person to run forward and backward simultaneously, an impossible feat. European nations had long harbored grievances against the dollar, with France repeatedly demanding gold redemption in direct challenge to the system's foundations. To revive a faltering economy, Nixon introduced interest rate cuts in 1970, hoping loose monetary policy would stimulate growth. This remedy proved counterproductive, unleashing a flood of capital outflows. According to U.S. Treasury data, net capital outflows reached $6.5 billion in 1970 and surged to $19.5 billion in 1971. This triggered a massive drain on gold reserves, which shrank from $11.82 billion to $10.21 billion. Compounding the crisis, 1971 witnessed America's first annual trade deficit, a $2.26 billion shortfall that punctured the bubble of trade balance like a thorn. The shadow of a triple deficit loomed over the nation, sparking fierce debate within the White House. Industrial capitalists advocated devaluing the dollar, arguing it would boost export competitiveness like freeing a drowning man from his bonds. But Wall Street's financial capital vehemently opposed its devaluation would drastically devalue their assets. Ultimately, the voice of financial capital prevailed, and the U.S. refused to devalue the dollar. This decision triggered global market panic, with nations dumping dollars to buy gold. The dollar became a hot potato on international markets, and U.S. gold reserves dwindled to just 25% of official foreign debt, nearing depletion. On August 15, 1971, Nixon delivered a bombshell in a televised address. The dollar would no longer be freely convertible into gold. A 10% surtax would be imposed on imports, and foreign aid would be cut by 10%. This unilateral breach of contract sent shockwaves through the global economy, like a boulder dropped into calm waters. Without gold backing, the dollar transformed from a hard currency into an unanchored drifting weed. Exchange rates plummeted, commodity prices soared, and global inflation spread like wildfire. European housewives scrambled to stockpile daily necessities, often clearing supermarket shelves within half an hour of opening. This panic swiftly engulfed most nations worldwide. Enraged European nations convened an emergency meeting of the 10 major industrialized countries in Washington. Under international pressure, the United States was forced to compromise. On December 18, 1971, the Smithsonian Agreement was reached. The dollar was slightly devalued to $38 per ounce of gold. Other currencies moderately appreciated, and exchange rate fluctuation bands were widened. Yet everyone understood this was merely a temporary measure like slapping a patch on a leaking ship. In June 1972, Britain became the first to abandon its fixed exchange rate, allowing the pound to float freely, triggering a new wave of capital panic. In the trading halls of the City of London, screens flashed the plummeting pound exchange rate as traders' cries echoed in waves. On February 12, 1973, the Nixon administration announced another 10% devaluation of the dollar, raising the gold conversion rate to $42.22. The Smithsonian Agreement collapsed entirely, and the Bretton Woods system officially came to an end. Amidst this global economic turmoil, a 35-year-old figure quietly stepped onto the world stage: Henry Kissinger. This German Jewish man had fled Nazi persecution with his parents to the United States at age 15, enlisted during World War II, attended Harvard after the war, and was later recruited by the Rockefeller Group, gradually ascending to the core of power. Nixon entrusted him with the monumental task of restoring the dollar's hegemony, mission akin to rebuilding a skyscraper from ruins. Kissinger shuttled incessantly between embassies and international conferences, his briefcase holding blueprints for reshaping the global monetary system while concealing America's ambitions to maintain its dominance. Kissinger keenly identified the key to breaking the deadlock: oil. The global economy's dependence on petroleum at that time was as vital as air to human life. On October 6, 1973, the Fourth Middle East War erupted. Arab oil-producing nations imposed an oil embargo on Israel's allies, sending crude prices soaring from $2.95 to $11.65 per barrel. The first oil crisis swept across the globe. While this crisis was a catastrophe for most nations with gas station lines snaking from streets to alleys and factories shutting down due to fuel shortages, for Kissinger, it presented a golden opportunity to reshape the dollar's hegemony. Academic circles offer to prevailing theories regarding the oil price surge. One posits it was deliberately engineered by the U.S. to find a new anchor for the dollar, while the other argues that the dollar's depreciation reduced oil-producing nations' revenues, prompting them to capitalize on the war to raise prices. Regardless of the truth, Kissinger seized the opportunity. On June 8, 1974, he shuttled relentlessly across the Middle Eastern desert. Neither scorching heat nor sandstorms could halt his diplomatic drive as he offered Saudi Arabia a heavyweight bait: hundreds of large-scale investment projects, preferential terms for purchasing U.S. Treasury bonds, increased MF quotas, and the sale of F-15 fighter jets. These conditions, like sugar-coated bullets, completely swayed Saudi Arabia toward the United States. At the time, Saudi Arabia was urgently seeking to develop its economy and enhance its defense capabilities. America's proposal precisely met these core needs. In 197.5, OPEC formally designated the U.S. dollar as the primary currency for pricing and settling oil exports, giving birth to the Petrodollar system. Saudi Arabia then used its massive oil revenues to purchase U.S. financial assets, facilitating the smooth return of dollars. This created a new circulatory system for the dollar. Nations had to hold dollar reserves to buy oil, and dollars flowing out of the U.S. would return through purchases of U.S. Treasury bonds, forming a perfect closed loop. The 1976 Jamaica Agreement formally stripped gold of its monetary status. effectively burying the Bretton Woods system and establishing a new dollar-centered order. Behind the smiles of U.S. representatives at the International Monetary Fund conference lay the resurgence of dollar hegemony. With dollar hegemony reborn, the U.S. economy accelerated down the path of deindustrialization, like a car abandoning its industrial engine to run solely on its financial motor. America weakened its general manufacturing sector, importing vast quantities of goods from abroad while exchanging printed money for global commodities. This debt-based economic model proved lucrative, raising funds through low-interest bonds to acquire profitable overseas assets. Data reveals that U.S. net overseas investment income surged from $15.5 billion in 1986 to $785 billion by 2007, as global premium assets flowed into America like a tidal wave. In Manhattan's office towers, financial professionals saw their incomes soar, while factories in the Rust Belt gradually fell silent, an economic imbalance already emerging in those years. But the price soon followed. The 1979 Iran-Iraq War triggered a sharp drop in global oil production from 5.8 million barrels per day to under 1 million, igniting the second oil crisis. By 1980, U.S. unemployment soared to 10.8%, inflation hit 13.4%, and the economy contracted, giving birth to the monster of stagflation. On American streets, unemployed workers marched with signs reading "I want a job." Store price tags were constantly updated, and the pressure on people's livelihoods intensified sharply. After President Reagan took office, he implemented neoliberal policies. The Federal Reserve aggressively raised interest rates, pushing them from 7% to 20%, using financial shock therapy to curb inflation. While this policy contained inflation in the short term, it also sowed the seeds for future economic volatility. High interest rates drove the dollar's appreciation, attracting global capital to flood into the U.S. and sparking a frenzy on Wall Street. Financiers vulture-like acquired major corporations, dismantled them into smaller pieces, and sold them at inflated prices, a scenario vividly portrayed in the 1987 film Wall Street. The movie's iconic line, "Greed is good," became the authentic epitome of Wall Street's ethos at the time. Manufacturing giants like General Electric and General Motors pivoted toward finance, relegating the real economy to a supporting role. Factory closures and worker layoffs shrunk the American middle class, widened the wealth gap, and normalized household debt. By 2007, U.S. consumer credit reached $2.5 trillion, with total household debt hitting $13.8 trillion, exceeding that year's GDP. Americans had grown accustomed to living beyond their means, piling up credit card bills yet reveling in the cycle. This consumption pattern underpinned the nation's debt-fueled economy. America's harvesting hand extended globally. In the 1970s, the U.S. provided low-interest loans to African and Latin American nations, encouraging them to develop oil reserves. But when these countries began production, the dollar appreciated and oil prices plummeted below $10 per barrel, triggering a debt crisis. In 1982, Mexico became the first to suspend debt payments, leading to a $76 billion capital outflow, a 30% devaluation of the peso, and economic recession. In Mexico City, anxious crowds swarmed currency exchange counters as the peso's plunge instantly eroded their savings. Argentina soon followed suit. To divert domestic discontent, its military junta invaded the Falkland Islands but was defeated by Britain, ultimately forcing Argentina to accept a U.S.-led debt solution. This military conflict not only cost Argentina its territorial sovereignty but also reduced its economy to a complete appendage of the United States. This solution was blatantly biased towards certain interests. It forced governments to assume private debt, slashed public spending to enforce fiscal austerity, drove currency devaluation, and added unpaid interest to principal, creating a compounding effect. Latin America's total debt stood at $839 billion in 1982, surging to $1.3 trillion just 5 years later. By 1989, the Washington Consensus imposed policies of market liberalization, privatization of state-owned enterprises, trade liberalization, and deregulation of labor markets on debtor nations. Latin American countries saw their state assets acquired cheaply by Western financial capital, gradually losing their economic sovereignty. In Brazil at the time, numerous state-owned enterprises were sold off to Western capital at rock-bottom prices, devastating the national industrial base and drastically lowering living standards. This plunged Latin America into its lost decade. Entering the 1990s, the dollar hegemony's extraction model persisted, becoming even more covert and efficient with globalization's advance. During this period, the Internet revolution emerged in the United States, where the tech bubble fueled renewed economic prosperity and drew global capital back to the country. Yet the Federal Reserve's monetary policy once again became the barometer of the global economy, with its cycles of rate hikes and cuts constantly disrupting international capital flows. Between 1994 and 1995, the Fed raised interest rates 7 times over 13 months. The strong dollar triggered massive capital repatriation to the United States, becoming a key factor in igniting the 1997-1998 Southeast Asian financial crisis. During the 1990s, the tide of globalization and financial liberalization policies propelled massive international capital inflows into Asia. Countries like Thailand, South Korea, and Indonesia attracted foreign investment with high interest rates, fueling rapid credit expansion in financial institutions. Yet this inflow carried pronounced short-term and speculative characteristics. Foreign capital predominantly existed as short-term debt, far exceeding the capacity of local foreign exchange reserves. Thailand's real estate market was exceptionally booming at the time, with skyscrapers rising rapidly. Yet behind this apparent prosperity lay hidden crises. On July 2, 1997, the Bank of Thailand abruptly announced the abandonment of its fixed exchange rate system. The Thai baht plummeted 17% against the US dollar in a single day, marking the official outbreak of the Asian financial crisis. This seemingly superficial exchange rate policy adjustment exposed deep structural flaws within the East Asian economic model. The crisis rapidly spread to Southeast Asian nations like the Philippines, Malaysia, and Indonesia. By year's end, it had impacted South Korea and reached Japan, ultimately evolving into a systemic regional crisis. Currencies such as the Malaysian ringgit and Indonesian rupiah plummeted consecutively. Stock markets crashed dramatically, and economic recessions followed in quick succession. Corporate debt chains snapped, triggering massive bankruptcies. Unemployment soared, and social unrest intensified. In South Korea, numerous small and medium-sized enterprises collapsed, leaving vast numbers of workers unemployed. Citizens began selling their household gold jewelry to exchange for currency, striving to maintain basic livelihoods. This crisis also undermined global confidence in emerging markets, fully demonstrating the capacity for regional crises to transform into systemic risks in the era of globalization. Following the crisis, the policy choices made by nations and international institutions profoundly shaped subsequent developments. The International Monetary Fund (IMF) provided emergency loans but attached stringent conditions, demanding recipient countries further open markets and reduce fiscal spending. South Korea was compelled to accept the IMF assistance program while simultaneously launching financial reforms, including dismantling chaebol conglomerates and clearing non-performing assets. Thailand gradually recovered through debt restructuring and industrial transformation, while Malaysia adopted aggressive measures like capital controls to stabilize its economy. These experiences demonstrate that effective crisis management requires balancing short-term stability with long-term reforms, as single policy approaches prove ineffective. Meanwhile, the United States profited once again from this crisis, acquiring substantial high-quality assets in Southeast Asian nations at bargain prices, thereby further cementing its economic hegemony. Following the bursting of the Internet bubble in the late 1990s, The Federal Reserve began cutting interest rates, reducing them to around 1% by July 2003. This low interest rate policy fueled unprecedented prosperity in the U.S. real estate market, rapidly expanding the subprime lending sector and inflating the housing bubble. Real estate agents aggressively marketed properties, and even individuals with unstable incomes could easily secure loans, with zero down payment and zero documentation loans becoming prevalent. To prevent potential systemic financial risks, the Federal Reserve initiated an aggressive interest rate hike cycle in 2004, raising rates 17 times over the course of this cycle. However, the rapid rise in interest rates and the swift downturn in the real estate market burst the housing bubble, ultimately manifesting systemic financial risks. In 2007, the subprime mortgage crisis swept across the United States, eventually escalating into the 2008 global financial crisis. The collapse of Lehman Brothers, the fourth largest investment bank in the U.S., became the defining event of this crisis. Wall Street descended into chaos as banks tightened credit. Businesses struggled to secure financing, and global financial markets plunged into panic. Stock markets worldwide crashed, wiping out massive market capitalization and drastically eroding ordinary citizens' wealth. To counter the crisis, the Federal Reserve rapidly slashed the federal funds rate from 4.25% to a historic low of 0.25%. And launched quantitative easing policies, flooding the market with liquidity. While this policy stabilized the U.S. economy to some extent, it also led to global liquidity excess and the reaccumulation of asset price bubbles. After the 2008 global financial crisis, the foundations of the dollar's hegemony were shaken but remained unshaken. The U.S. leveraged its dominant position in the global financial system to shift the costs of the crisis globally. Emerging market economies became the primary victims, experiencing massive capital outflows, currency depreciation, and slowing economic growth. Meanwhile, the U.S. employed quantitative easing to devalue the dollar, alleviate its debt burden, and stimulate capital repatriation to fuel domestic economic recovery. Data shows that from 2008 to 2014, the Federal Reserve expanded its balance sheet from approximately $900 billion to $4.5 trillion through 3 rounds of quantitative easing, flooding global markets with dollars. In December 2015, the Fed initiated another interest rate hike cycle, raising rates 9 times by the end of 2018 concurrently. It launched a balance sheet reduction program in October 2017, reducing the money supply in the market. The dual impact of rate hikes and balance sheet reduction hit emerging market economies which have high external financing needs the hardest, causing severe damage. In 2018, the Argentine peso depreciated 50.56% against the dollar, with inflation soaring to 47.6%. Brazil's real fell 20% against the dollar, and the Turkish lira plummeted over 30%. These nations' economies faltered, living standards declined, and social instability grew. Meanwhile, the United States once again used its interest rate hike cycle to attract global capital inflows, consolidating its financial hegemony. In 2020, the global outbreak of COVID-19 brought the world economy to a standstill. The Federal Reserve launched another round of unlimited quantitative easing, lowering interest rates to near zero while purchasing large quantities of treasury bonds and mortgage-backed securities. Its balance sheet expanded to over $8 trillion at one point. The massive injection of dollars reignited global inflationary pressures, driving sharp increases in commodity prices. Leveraging the dollar's status as the international reserve currency, the U.S. easily weathered the pandemic's economic shocks. Its stock market rebounded swiftly after a brief dip, even reaching record highs. This pattern of America getting sick while the world takes the medicine reignited global resentment toward dollar hegemony. In March 2022, to combat high inflation, the Federal Reserve initiated a new cycle of interest rate hikes. By May 2023, 10 consecutive rate increases had cumulatively raised rates by 500 basis points. This aggressive tightening triggered a regional banking crisis in the United States. On March 10, 2023, California's Department of Financial Protection and Innovation announced it had legally taken over Silicon Valley Bank SVB, a regional bank primarily serving startups, and appointed the Federal Deposit Insurance Corporation FDIC to oversee its liquidation due to insufficient liquidity and solvency. SVB's closure triggered market panic, with depositors rushing to withdraw funds and bank stocks plummeting. Following SVB's closure, the U.S. Treasury Department, Federal Reserve, and FDIC issued a joint statement on March 12 announcing that Signature Bank, headquartered in New York City, had been closed by local regulators. On March 19, the Swiss government announced that Credit Suisse would be acquired by UBS Group, marking the first acquisition involving two globally systemically important banks since the 2008 international financial crisis. On May 1, First Republic Bank was closed by California's Department of Financial Protection and Innovation and taken over by the Federal Deposit Insurance Corporation. J.P. Morgan Chase subsequently acquired all deposits and the vast majority of assets from First Republic Bank. The ongoing regional banking crisis in the U.S. has exposed the vulnerability of American financial markets within the dollar hegemony system. Simultaneously, the trend of weaponizing the dollar has heightened the risk of fragmentation within the international monetary system. The U.S. and its allies freezing Russia's foreign exchange reserves and excluding its financial institutions from the SWIFT system signifies the increasing use of dollar financial instruments for geopolitical purposes. This action not only undermines the credibility foundation of the post-Bretton Woods system but also prompts developing countries to reassess the security of their foreign exchange reserves. Many nations are reducing their dollar holdings while increasing allocations to other currencies or gold, driving diversification of foreign exchange reserves. The re-election of a certain figure as U.S. President in November 2024 signals a further strengthening of the America First unilateralist tendency, sparking widespread global concern about the future trajectory of the international monetary system. Subsequently, a series of policies introduced by the administration added further uncertainty to an already turbulent international monetary system. The government's promotion of a global reciprocal tariff concept fundamentally undermines the WTO's core principles of free trade, most favored nation treatment, and comparative advantage. The WTO issued a statement warning that U.S. tariff policies could cause global merchandise trade volumes to contract by approximately 1%, nearly 4 percentage points lower than previous projections. In November 2024, a report titled User Guide for Reconstructing the Global Trade System, authored by a key figure from the White House Council of Economic Advisers, proposed urging trading partners to convert their holdings of short-term U.S. Treasury bonds into ultra-long-term bonds with low or no interest rates, while addressing liquidity issues through currency swap agreements with the Federal Reserve. While this approach could temporarily alleviate the U.S.'s external debt burden, it fundamentally undermines the safe haven asset status of U.S. Treasuries. Furthermore, the U.S. government has weakened global multilateral mechanisms by dismantling the U.S. Agency for International Development (USAI) and pressuring the International Monetary Fund (IMF). The termination of USAID signifies America's deliberate abandonment of its long-standing leadership role in global development assistance, systematically eroding the post-war global aid framework. To consolidate dollar hegemony, the U.S. government is also implementing strategies such as strategic Bitcoin reserves and aggressively promoting the development of dollar-pegged stablecoins to strengthen digital dollar dominance. With U.S. government backing, stablecoins are poised to become a key tool for strengthening the dollar's international currency status in the digital financial era. Compared to the traditional dollar hegemony system anchored in oil trade and the SWIFT system, dollar-pegged stablecoins pioneer a new dollar cycle leveraging blockchain technology, supplementing traditional financial markets. With digital dollar liquidity, this initiative seeks to maintain the dollar's dominance in the digital economy era but has also sparked global concerns over digital financial hegemony. Faced with the arbitrary actions of dollar hegemony, nations worldwide are actively seeking countermeasures, sparking a quiet de-dollarization wave. The Financial Times website noted that the US's importance to global trade may be overestimated, with data showing its share of global merchandise imports at just 13%, a significant decline from nearly 20% 2 decades ago. Simon Evanet, a professor at the International Institute for Management Development in Lausanne, Switzerland, concluded through modeling simulations that even if the U.S. completely cut off imports, 70 of its trading partners could compensate for the loss of exports to the U.S. within a year by maintaining export growth to other markets, while another 115 partners could do so within 5 years. The trade wars provoked by the U.S. are fostering new alliances. According to DPA, in early April 2025, the EU reached a €12 billion investment agreement with 5 Central Asian nations and explicitly designated Central Asia as a reliable strategic partner at the Uzbekistan summit. An EU official stated, Europe has agreements with 76 countries and is expanding this network. We recently concluded trade deals with Mercosur, Mexico, and Switzerland, and established our first partnership with South Africa. Our goal is to finalize a trade agreement with India by year-end. While intensive negotiations are underway with Indonesia and Thailand, ASEAN nations are also discussing collective countermeasures against unilateral U.S. import tariffs. In the monetary sphere, an increasing number of countries are promoting local currency settlements. Multiple nations have substantially raised the proportion of local currency settlements in bilateral trade, reducing reliance on the U.S. dollar. Relevant planning documents propose advancing the internationalization of domestic currencies, enhancing capital account openness, and building autonomous and controllable cross-border payment systems for domestic currencies. Amid shifts in the international environment, the development path for domestic currency internationalization has shifted toward a strategy of regional precedence with global linkage. At the regional level, this involves establishing an Asian financial safety net, promoting trade settlement in domestic currencies, and developing digital currencies. Globally, it entails maintaining the pace of capital account openness and exchange rate flexibility, while enhancing institutional influence. The current international monetary system suffers from 3 structural flaws. First, the broader Triffin dilemma remains difficult to overcome. As the issuer of the world's primary reserve currency, the United States must continuously supply global dollar liquidity. This necessitates persistent current account deficits and rising net foreign debt, eroding the dollar's credit foundation. Second, the spillover effects of U.S. domestic policies have significantly intensified. Monetary and fiscal policies formulated based on U.S. economic conditions often carry global implications, substantially increasing capital flow shocks and exchange rate volatility risks for emerging markets and developing countries. Third, the trend of weaponizing the dollar exacerbates the risk of fragmentation in the international monetary system. Rebecca Greenspan, Secretary General of the United Nations Conference on Trade and Development, stated, global trade rules must evolve to meet today's challenges. Analysts suggest 2 potential futures. One scenario involves the United States being excluded from the global economic and trade system, with its market becoming increasingly isolated and shrinking, ultimately losing its voice in global supply chains and value chains. The other scenario involves the United States forming trade agreements with select nations, primarily Canada and Mexico, alongside other partners. Currently, at least in the short term, neither de-dollarization nor de-Americanization appears feasible. The United States will remain a major global power, though it will pursue strategic retrenchment and decline to serve the world. Looking back over more than half a century, the dollar hegemony was reborn from the collapse of the Bretton Woods system. consolidated its position through the petrodollar system, and reaped global benefits through monetary policy cycles. Yet it now faces multiple internal and external challenges. Manufacturing accounts for only 8.4% of U.S. GDP, and the economy's fragile reliance on debt and financial markets remains unchanged. The global economy's path dependence on the dollar system resembles being mired in quicksand, yet the wave of de-dollarization is unstoppable. On the global economic stage of 2025, the game of dollar hegemony continues, but participants' mindsets have shifted. Nations no longer passively accept U.S.-dictated rules but actively pursue diversified development paths. Where will this economic restructuring begun under the shadow of the Vietnam War ultimately lead? Will the era of dollar supremacy come to an end? How will a new international monetary system and global economic order be constructed? Time will ultimately provide the answers to these questions. What is certain, however, is that the trend toward a multipolar global economy is irreversible. A more equitable, just, and inclusive global economic order is gradually taking shape through the collective efforts of nations worldwide.